I appreciate you taking a few minutes to check out this video from NetPicks, and today I'm going to do something a little bit different. Usually I have a little bit more scripted videos, and the reason I do that is because I tend to want to over-explain, and then I'll see something and I'll want to go off in that direction. So my videos could really end up being a long time. But I had a lot of questions about the 3 EMA strategy that I posted a while ago. And if you have not seen that video, in the description is a link, and above here is a link. I suggest you watch that first and then come back, because I'm not going to cover everything about it. So to cover the questions I had, I'm going to look at the Pound Aussie 15-minute chart, which is obviously a day trading time frame, and just walk through a market that moves from consolidation to a downtrend to an uptrend. And I made some notes to keep myself on task. And the first thing I want to talk about is when we have moving averages converging like we are seeing here, we want to consider ourselves in a range and step aside or use your range trading strategy. But what we need to see happen, and we have it happening here, is our 9, our 21, our 55 EMA have all decided that we're now in a downtrend. Now we want to enter a short trade. And to do that, we need a break of these lows and a close. So you can see over here is where we get the downside move, all the moving averages pointing to the downside. But we don't just trade there. We want to see a break of lows. Why? Because for a downtrend, lower highs and lower lows are what makes that a downtrend. So on this candlestick here, we get to the low of these candlesticks, but we close on the lows. We don't close below these lows. This next candlestick is where we do. The basic strategy is we would sell at this close. I use a 14-period ATR, which is an average true range, for my stop and for my targets for this. Now, you could change all that. All right, you can use 1 ATR for your stops, 2 or 3 ATR for your profits. I just sticking to something basic here, but I use ATRs for virtually all my trading. We would put our stop up here, and here's our target. And you can see that this trade just plummets right down. And we get really close to our 2 ATR target, and price starts to pull back. If you're in this trade, you do not want to give back all of this profit, because when we see something like this, this does not say weakness, does it? Even though our stop's way up here, why give back all this profit and take a loss? So managing your trade is vital. And if you did not manage here and you saw this low put in, which is higher than this, I would hope that you would start managing your trade a little bit better. So this trade would have been a profitable trade. How much you would have profited depends how you manage the trade. So over here, we can see we're moving up. Our 9 crosses the 55. Our 21 now crosses 55. So the 55 is now below all of them. That's what we need for uptrend. And we get that. This low is taken out by this candlestick here. If we just went objective and bought the close of that candlestick, we obviously get stopped out in this trade. So this is where a little bit of trading knowledge can come in handy, and it's looking at these kind of candlesticks, and does this candlestick yell at you this is going to be a continuation move? To me, it's an indecision. So when we get markets that are changing states, it can oftentimes be a noisy area. So be very careful trading around that. But if you did just say, you know what, I'm trading it totally objective, you got stopped out in this trade. Market pulls back. Our mechanical system uses a 9 and 21 crossing, but we're not always going to get that. So more advanced traders may say, okay, we got to pull back here. This was a resistance zone over here. Price broke resistance, pulls back. We don't know if it's going to act as support yet. So it's a potential support area. What we do have happen is price pokes back into this area here and is immediately bought back up. Right? So that's a rejection of this level. You can use that for your entry. We can use the price structure, which I just talked about, or we can use a 3-bar entry. And what that is this. Let's get these 3 candlesticks here. We get this. We get the low is taken out. And then we get the second candlestick here. Right? This low is taken out by this candlestick, by the number 2 candlestick. If this candlestick closed above this low, above this close, you could buy. But it doesn't. So we look to the 3rd candlestick. We need this third candlestick to close above the close of this candlestick. In this instance, it does. You would buy here. Obviously, with 2 ATR, you'd be out of this trade for a profit. Okay. Moving over here, you see it's more of a range that we're trading in. But what we do get here is the perfect 921 continuation trade. Market pulls right back here. We go back to how we would trade a whole change of trend. We need a break of a high for an uptrend, break of low for a downtrend. This candlestick breaks this high. You would buy the close. This is our 2 ATR stop, 2 ATR profit target. We could also use the 9 EMA as a trailing stop. You know, you've heard it said that generally the first pullback in a new trend is the best one to get involved in. There's a flaw in that logic, and that logic assumes that you know that's going to be a trend. We don't know a trend is happening until it's happening. So keep that in mind. What I want to talk about here is you can see the separation between the moving averages. We got a market that's moving pretty far from its mean. When that happens, we want to be on alert for a mean reversion, a snapback in price. So when this starts to happen and you're in a trade, you want to make sure that you're maybe a little bit more aggressive with your stops than you would be otherwise. You see we get our pullback into here. We don't get our 921 cross, but we do get a price consolidation. So we have 3 ways we could enter it. We can use that bar pattern, which we do see with that green arrow, a break of highs, or a trend line break. This is our 3-bar pattern here. 1, 2, 3, buy. Obviously, you'd be out of the trade long before it got to here for using ATRs. We could trade a break of this trend line, which brings us absolutely right up into this level here. Or we can just say, nope, we're going to not trade breaks like this. I'm going to go off topic 1 quick second here. Diagonal lines like this, you know, I don't even know. They're so subjective how you draw them. However, on this one here, a break of the high would be this candlestick here. Price goes up, pulls back. I'm not sure where the stop would be on this one. If this is the close, could be around here. Let me just bring up my ATR just so I can see it. Your stop would be right here, and you can see that it doesn't. So let me just see right there. Your stop would be here. You can see it doesn't get hit here, but we do get our profit target on this candlestick here. Again, what we have here is we get our pullback. We don't get our crossing of the 921. We do get our 3-bar pattern here. It's not picture perfect, but it is that pattern. Or we could just wait for a break of this high, which is this candlestick here. And you see this trade just took off to the races. And remember, we talked about using the 9 EMA as a trailing stop. Would have come in handy on this one here. So our price has really gotten away from the average price down here. And here comes our snapback. Would you trade this? When you're looking at trading pullbacks, what you don't want to see is momentum in the pullbacks. But we don't get any trade here we could take. We do get our 921 cross, but if you look at our basic 921 cross, we need a break of highs, which is way up here. We don't have our 3-bar pattern. We look over here, we do get that pullback. We do get a 3-bar pattern. The little nuance with the 3-bar pattern is we don't want candlestick number 1 to being a strong momentum kind of candle. So depending on how you look at this and how you interpret this area right here, you would not be in a trade. If we went just with the objective way of trading this, we would not be in this trade because our high is way up here. This is a trading range. We're stuck between this high and this low. So I hope that answered some questions that people have. And if it didn't, let's pop some questions below and I'll get to them. Appreciate you watching.